Bismillahirrahmanirrahim. So we are continuing on monetary and fiscal policy, and this is chapter about monetary policy. What we will say in this is very different from what people actually do on the basis of wrong ideas about how monetary policy should be done. So it's very strange that there are very simple and basic and fundamental misunderstandings which are very common and widespread, and monetary policy is done on that basis, and this leads to many different problems. Alright, so let's just get into it. So this is the chapter outline, modern banking operations. We will explain how banks work, which we have already done. We will explain how basically central banks used to target the money supply. We will keep the growth of money supply at 6%. That was the Friedman's rule, for example, or some other. Then this was abandoned, and nobody targets money supply anymore, and now we have something which is called inflation targeting. Even the state bank is moving towards that goal. There is the issue of liquidity management, how much money is there in the economy, which is actually under the control of the state bank. Then we will ask about what happens when you do monetary policy, which is basically cutting the. So that's the mechanism of transmission. When you change the discount rate, what is the effect of that on the economy? And then there's unconventional monetary policy, which we have seen, because conventional monetary policy failed to work. These involve quantitative easing, negative interest rates, and finally there is actual practice, how monetary policy has been done over the past few decades. And then there's the issue of central bank independence, which everybody talks about, but nobody understands what it means. And then there's horizontal and vertical integration. Alright, so why did we go to interest rate rather than monetary targets? We should be able to understand what the central bank does, and then what the effects of these actions are on the economy, and also understand what this debate about central bank independence is all about. So one thing I can tell you is that the material we study here, I didn't know when I was in the Monetary Policy Committee, and none of your graduate students who are taking macro elsewhere are learning this. So, alright, so how does the central bank function? We've already covered this, but the first few times it's difficult to understand. Basically, the central bank makes payments on behalf of the government. When the government writes a check on its account on the central bank, when that check is deposited by any bank, normally it will be deposited, the checks are always deposited. So this check will be, when it is deposited, it will create reserves in the holdings of that bank in the account that the bank has at the central bank. At that point, the money creation has taken place. The central bank has created high-powered money which has been placed onto the account of the private bank. Now there is an offsetting transaction. This amount is deducted from the account of the government. But this is a fake transaction. The government really doesn't own anything. It doesn't owe anything to anybody. We could just remove the government account from the picture and everything would work as before. But the presence of the government account leads the people into the foolish misunderstanding that the government has a certain amount of money and it can only spend from the amount of money that it has. This is not true. So one of the things is the high-powered money creation. The other thing is that the government might say that we would like to sell some treasury bonds or T-bills. So when the government sells treasury bonds to the banks, this also supposedly generates revenue for the government. Actually, this is not the correct understanding, but this is the understanding with which the world operates. So the government needs money, and one way to get money is to sell bonds to the public. This is not actually true. What happens is that whenever the government spends, the money it needs automatically comes into existence. Now, when this money comes into existence, it might be that there is too much money in the market. So what the central bank does is that it sells some bonds to mop up this excess money so that the extra money does not cause problems that might arise. So then the central bank doesn't actually collect the revenue, but when the Central Board of Revenue collects revenue, then it deposits it in the central bank. That money basically you can think of as being destroyed in the correct picture of the world. But in the misunderstood picture, this tax revenue goes into the government account and gives the government money from which it is supposed to spend. But we can, if you want to understand how the economy works, you can say that the tax money is taken and burned, is destroyed. So basically it's a way to reduce money holdings in the public. It also regulates private banks, in particular money created by the private banks is also subject to central bank control. All of these things impact on the liquidity in the market and on interest rates, and the central bank has to manage these things. But basically the central bank, except for the interest rate which is in the control of the central bank, the money liquidity conditions are more or less governed by treasury actions, and the central bank is playing a reactive role. If the treasury spends too much money, the central bank just mops it up. If it spends too little, then it provides extra liquidity. So it has to basically accommodate whatever the treasury is doing. So it's sort of the partner of the treasury. Cannot be, in that sense, it cannot be too independent. So the standard operation of monetary policy is based on three claims of sound finance, which are still widely believed and they influence policy. And in this textbook, these three claims are rejected. So these are the three claims. The first thing is that, okay, if government runs a deficit, it can finance it by money creation, by saying that, okay, just print the money and pay. So this is called high-powered money. And the idea, the claim is that if the government does finance deficits by creating money, this will lead to inflation. So the way that this is done today is that the high-powered money, instead of the government creating it, it borrows it from the state bank and puts it into the account, its own account. So at least, so then we say that the central bank creates the money and lends it to the government. So this is a two-step operation, but we could just say that the government creates this money. The loan between the government and the central bank is a non-issue. Okay, so that's one way. The other way is that the government can print T-bills and say that, okay, you buy this and I will pay you, instead of 1,000 rupees, I will pay you 1,100 rupees at 10% 1 year from now. So this is a T-bill. You can print those, the government can print those and sell them. And that's another way to raise money. So basically the standard thought is that the government will either finance its spending by revenues earned from taxes, or by money creation, or by bond sales. And now the MMT rejects this, all three of these claims. So now the standard theory is that if you finance the fiscal deficit by bond sales, this will lead to crowding out, because there is a certain amount of money that is available as loanable funds. This is the name. And these funds, if they go to the government, then they will not go to the private sector. And so you will have more investment in government bonds and less investment in private sector. So this is called crowding out. So again, MMT rejects this idea. And the third idea is that high deficits have adverse economic effects, which may be related to the first two. So all these three claims are rejected by modern monetary theory. But the point is that because they are widely believed, people are very afraid of running fiscal deficits, and they don't. They try to balance budgets and okay. So we have some. All right. So now we think about how banks work. So basically, banks have accounts. It is very useful for our own mental clarity to differentiate between two things and keep them completely separate. One is the money which the bank has. These we can call reserves. And the other is the accounts that the people have in banks. So we can think of it as a two-stage process. All banks have accounts at the central bank, and then private sector has accounts at the banks. Now the amount of money that the people have in their accounts in the bank is very loosely related to the amount of money that the banks themselves have, which is called the reserves. So there is basically the banks give loans to people, and those loans are the accounts that they have. They can give loans arbitrarily. They don't have to have money to give loans, because they can borrow whenever they want and however much they want from the central bank. So they just write a check that, okay, you have this much now. They keystroke money into existence when they give loans. They also have reserves. So when the loans come in and somebody wants cash, which is not typical, then they can either use their own reserves, which they have in their own vaults in the branches of the banks. So they keep some cash for this kind of purpose. Or they can, if they have insufficient cash, they can borrow from some other bank, or they can ask the central bank for a loan, so the central bank gives them, or they can ask the central bank to give back some of their reserves. So when the central bank gives them money, the central bank is authorized to print money when necessary. So when the bank says that I want 1 million rupees in cash, so the bank can say, okay, it prints 1 million in cash and deducts their account at the central bank by 1 million. So they can meet their cash reserves. They try to keep small amounts of cash reserves in their private banks, the minimum necessary for the daily transactions. But the bigger part of the transaction, the vast majority, is done by checks. So people write checks on their accounts. All the people write checks. So the checks are basically going from one bank to another bank. All of these checks are collected at the end of the day, because they are all electronic, at the central bank where everything happens. So at the end of the day, we have clearing, which takes place. So clearing takes place. So all of the checks are cross-cancelled. There are 1 million checks from HBL to UBL. So all of these are deposited into UBL. There are similarly 1 million checks from UBL to HBL and to all other banks. So at the end of the day, you do plus minus counting, and in the end, some banks will have surpluses, some banks will have deficits. So now those banks which have surpluses will transfer these surpluses to those banks which have deficits. Sorry, no, that's not right. Those banks which have, well, first of all, clearing takes place so that the checks are cleared. Now, at that point, after the end of, at that point, the bank knows how much reserves I have after the interbank clearing takes place, and then it looks at, do I have 3% of what I owe to the other people? So that's required. So if they have less than 3%, then they must borrow from some other bank that night. That is why you need the overnight market. So you have to bring it up to 3%. Every 2 weeks, fortnightly, you have to have 5%. So temporarily you can run low, but I think your average over fortnight must be 5%. So basically the banks target to keep 5%, but they can allow it to go down. But so towards the end of this fortnight, 15-day period, they try to get excess reserves because in order to make up for the average if they haven't been maintaining the average. So there is a surge in interbank borrowing towards the end of the 15 days if there is shortage of reserves. If there is excess reserves, this is so the banks borrow on the interbank market, or they borrow from the central bank, but the borrowing from central bank doesn't take place by asking for a loan. What they do is they give their every bank is required to keep 19% of its account in T-bills. So basically they sell some of their T-bills to the central bank and get money, or they use the T-bills as collateral to borrow from the central bank. They say, okay, I have this much bill that will be held as collateral for the loan. So the central bank is also the lender of the last resort. If there's a huge run unexpectedly, so everybody arrives at the bank that I want cash, which happened after the global financial crisis, then the bank can borrow from the central bank. It need not borrow against collateral. In that case, this is called the lender of the last resort. So in that case, the bank writes a check to the central bank that this is what I owe you, with nothing behind it, and the central banks gives them cash. So that's called the lender of the last resort. So this is how banking operates. All right, so in the 1960s, we had monetarists thinking that the central bank controls the money supply, which is the high-powered money, and then there is a multiplier K, which is applied to this to generate the money in the economy. So if I control the level of the high-powered money, then I control the level of the economy, money in the economy. I think this theory is still being taught in textbooks, but it is just completely wrong. By the mid-1980s, this theory was sort of applied between 1960 and 70 and 85. By mid-80s, the central banks understood that they cannot control the money supply because basically money supply comes into existence via the operations of the private banks. When the private banks lend, that creates not so much, not really money, but credit, and that credit goes into M2. It's useful to separate so the credit is the money that's created by the private banks. But in the private sector has credit, which is a credit is a loan of the private bank. That's the better way to understand it. We think of a deposit at the bank as being cash that the bank is holding for me. That is the wrong way to think. My deposit at the bank is just a loan that the bank has, that the bank owes me, money that bank owes me. When I go and ask for this loan, then they make arrangements to pay for it. Otherwise, it's just an electronic entry. It's a paper, it's a memo of the bank that I owe you 1,000 rupees. The memo is just the piece of paper I have, which is backed by the bank's promise to pay if I show it this loan. There is nothing behind that. This is the major misconception. So, because the money is credit which is created by the banks, the central bank doesn't have much control over this. And so the central bank cannot control the money supply. And that's why the money supply switched to controlling the discount rate, which the bank can do, because the bank makes loans, and it can ensure that the CIBOR, the interbank lending rate, is at a policy level, again only by intervening in the market. If the rate goes, there is actually a corridor. When currently the lending rate, the policy rate of the central bank is 10.25%. The corridor is 0.5% above. So as long as the CIBOR is below 10.75%, the bank does not interfere very much. If the rate hits 10.75, then the bank will start. This signals what? Shortage of reserves or excess? Shortage of reserves, yes. People are trying to get reserves and they cannot get, so the price of reserves is going up. So now the bank will actually start buying T-bills at 10.75% yield. Remember that the face value of the T-bill is something else. The face value may be 5% interest, for example. So the price fluctuates to make the yield equal to the policy yield. So if you sell it cheap, then this 5% becomes 10%. If you sell it expensive, it becomes 1%. So according to the price at which it is sold, the face value of the bond is 1,000 rupees and it will pay 1,100 at the end. So the coupon value of the bond is 10%. But by changing the price, if you set it to 900, the rate will become 10%. And if you sell it at 1,050, the rate will become 5%, something like that. So the price of the bond controls the rate. High price, low yield; low price, high yield. So the bank starts buying T-bills that the banks have in order to provide them with reserves at the ceiling rate. So the rate cannot go above ceiling, because if some bank wants to lend above ceiling to another bank reserves, the bank will go to the central bank instead and get rate at the ceiling. Similarly, the floor is not half but 1 whole point below. So 10.225, 9.25 is the floor, if I remember correctly. Yes, 9.25 is the floor, and so the CIBOR can slip down to that. But if there is so much excess liquidity that the money is being that the reserves, the rate of reserves is slipping below 9.25, then the central bank will intervene and it will actually start doing what? Buying or selling bonds? It will start selling bonds to mop up reserves, yes. So there is excess money in the market reserves, so the bank will sell bonds and give them the yield of 9.25, so that the yield will never go below 9.25. So these are called open market operations, which the bank does. Now, why does the bank set the discount rate at 10.25? This is a real mystery, because basically the announced goal is that this will control inflation, but actually the link between the discount rate and inflation is not at all clear, how the discount rate affects inflation. So this paper by Daniel Tarullo, who was the governor of Federal Reserve, so he should know, is called Monetary Policy Without a Working Theory of Inflation. So this paper makes the following 4 points. We do not have a theory of inflation that works well enough to be used for business of real-time monetary policy making. So when we set the policy rate, there is no theory which tells us how this will actually impact on inflation. So it's just guesswork. Nonetheless, the people who are making policy, myself and other people, we are using models which are based on these problematic concepts like the expectation augmented Phillips curve and hard to estimate variables. Some variables that are involved is the expectations, for example, which is hard to estimate, and there are other variables which impact on inflation, like what will happen tomorrow, basically, not just the expectations, but what the business are going to decide in terms of their investment climate and so on, how much foreign direct investment will come in, etc. So these are the two conclusions. However, basically, he doesn't go very far with this observation. He says that nonetheless, we still need to do more or less the same thing, and macroeconomists should continue to play a leading role. That is not clear why he's saying that, but basically he says even though all our theory is wrong, we should just continue to use it. So the textbook says that in the 1970s, the policy was based on the expectation augmented Phillips curve, which we have discussed in great detail. So one of the key conclusions of the EAPC is that there is a natural rate, so we should not use fiscal policy, because if we use fiscal policy to control unemployment, this will cause a temporary decrease in unemployment, but this will then get built into expectations, which will cause a permanent increase in inflations. So short-term gains from fiscal policy are sacrificed by the long-term pain that is created by excess inflation. So the conclusion is that the monetary policy should be used. Do not use fiscal policy. We should only use fiscal policy, and the only object of monetary policy is to control inflation. So stable prices should be the goal of policy. And basically, how much money we print, we should separate the central bank from the government, so that the government doesn't ask it to print money to finance deficit. That way, independent authority of central bank will. Otherwise, the government will finance deficits by printing money and cause inflation and do other sorts of damage. So these are the basic three lessons that come out of the expectation augmented Phillips curve, and these are the lessons which are still being used to guide monetary policy at banks all over the world. So FOMC is the Federal Open Market Committee, and there are some manuals which explain what the goals are. So these are the Federal Reserve goals. So Federal Reserve has what is called statutory mandate. These are the statutes which are used to govern the actions of the central bank, and basically in the US its inflation target is 2%. No, actually, there is no officially written target in the statutory mandate. It just says that you should promote maximum employment, you should keep prices stable, and you should have moderate long-term interest rates. And the federal FOMC has interpreted this statute to say that 2% is the right rate of inflation that we should try to maintain. And the people on the FOMC, which is called the MPC in Pakistan, the Monetary Policy Committee, in the USA they estimate that the normal rate, that's the natural rate, is about 4.9% in the long run. So if it is above that, they can use policy to try to bring it down, and if it's below, then they can actually tighten monetary policy to prevent the overheating of the economy, as it's called. Similarly, in the Bank of England, the government's economic objectives are growth and employment, and in Australia, maintenance of full employment, economic prosperity and welfare. These are the goals. So the central bank is responsible to achieve these bigger goals for the economy. So the independence has to do with how it does it, but not what it is supposed to do. So again, that's another constraint. The bank can't do whatever it wants, because if the goals are not met, if the inflation occurs, or if some other form of financial instability occurs, then what can happen is that the government can try to tell the state bank that this is wrong and you are violating your mandate, and they can do many kinds of things. Another responsibility of the state bank is the stability and crisis prevention. And for example, after the global financial crisis, banks were in big trouble because their assets had been wiped out. There was a big, first of all, they were holding these mortgage-backed securities, and the value of the housing market had collapsed, so these securities were worthless. So at that point, the central banks in Europe and USA printed trillions of dollars and just gave them to the banks. So this printing of trillions of high-powered money did not cause any significant problems. This just shows, and in fact some economists said that we were surprised that this did not lead to inflation, because our theories tell us that if you create so much high-powered money, then you will get inflation. Inflation should be completely proportional, but the US printed $1 trillion high-powered money, and there was no impact on inflation, zero. So this idea that the quantity theory, that the more money we have is the more inflation, this doesn't seem to be valid. So liquidity management, basically what we have been saying is called the theory of endogenous money, which means that the provision of reserves is horizontal. However much you want, you can take at the going discount rate. Arbitrary amounts of reserve will be supplied by the central bank at the policy discount rate. And this is what happens. So this is called endogenous money because the central bank does not control the amount of reserves. The HPM, high-powered money, is not, and the government decides how much money to create. But it responds, it creates HPM in response to demands by the private sector banks. So if the private sector banks are making a lot of loans and they need their 3% or 5%, they will say, okay, I've made a extra 5 million rupees of loans today, so please give me 1 million rupees to satisfy my liquidity requirement. So the central bank will generate reserves, yani print reserves, and give them to the bank on overnight basis or some other basis. They can also give money to the banks on longer basis by T-bill sales or purchases. Now, what happens if fiscal policy is done? Suppose the government runs a deficit and it prints a lot of money. Will that cause changes in this theory of flat reserves? No. What happens as a result? One might think that, okay, the government can control the money supply by using fiscal policy, that the government runs deficits, that will create high-powered money. But this is also not true, because when the government spends, this creates excess liquidity in the market, and if the bank wants to maintain the policy rate, then it has to mop it up. So it will basically cancel out the existing liquidity, the surplus liquidity. And similarly, if the government runs a surplus, it collects more taxes and puts it in, and doesn't have much spending. That will reduce the money supply in the market and lead to a situation of deficit liquidity, which will push up the discount rate. And so what will happen as a result is that the bank will pump liquidity into the market. So it means that the reserves are not really in control of the bank, central bank. So basically the standard theory of money creation, money multiplier, where the central bank controls the amount of high powered reserves and then the money supply is determined by a multiplier, this is just completely wrong. So after that's theory. Now we come to the practice, what happened in the real world. So after the global financial crisis, basically the banks there were no reserves. The reserves were wiped out because the assets were wiped out. So what the central bank did is it pumped a huge amount of reserves into the economy, and the zero interest rate policy was put into effect in most places, so that banks will hold excess reserves. Generally speaking, banks don't want to hold reserves above the statutory requirement. So for example, Pakistan, banks would like to hold 5% reserves. Actually they have more. They have what is called excess liquidity. If there is a interbank rate that is higher than zero, then no bank would like to keep excess liquidity, because they can earn money on the excess by lending it to other banks. But if there is excess liquidity all around, if the amount of money being paid on reserves is too low, is zero, nearly zero, then the banks can afford to keep excess liquidity. So in the UK, in the US, the federal bank discount rate was 0.25, a quarter of a percent, which means that was the ceiling. So the banks can lend on the private sector to other banks' reserves at less than a quarter of a percent. This is an annual rate. So basically it is more or less zero. So the banks would just hold excess reserves. The Bank of England recently wrote a paper in 2014 in which they explicitly said that the standard theory which is taught in textbooks about the money multiplier is wrong. This is not the way the world works. So basically they allowed that banks can have excess reserves, and banks have had excess reserves since and this has not led to money creation. So this part is the tricky part, that okay, reserves do not automatically lead via the multiplier to money. Nonetheless, there is the hope that if the banks have a lot of credit, they will lend it to others. So that's so the Bank of England has rejected the multiplier, but it has not rejected this theory, that okay, if we give them a lot of reserves, then maybe the banks will lend more, although it's not a mechanical process. So now we look at the transmission mechanism to assess, is it true that if we raise the discount rate as the bank has done, this is a way to control inflation? As the State Bank of Pakistan, the main reason that the rate has been raised is because the inflation is rising, and the theory is, this was explicitly said at the Monetary Policy Committee, that see, once you have inflation, this gets built in. This is the standard part of the expectation augmented. So we have to control it before it starts. Otherwise, if you allow it to go on, and this is actually true, that is, it is true, this is that once everybody is anticipating the inflation will take place at 10%, this becomes a self-fulfilling prophecy, because everybody will make calculations that 1 year from now the prices will be like this. So the people who are demanding wages, they will say, okay, there will be 10% inflation, so we should get a 10% wage increase. So basically then when the wages increase 10%, then the prices will also have to increase 10%. So if there is a consensus on a certain number, for everybody knows that this is the inflation, then this will become a self-fulfilling prophecy. So how does monetary policy work? Well, monetary policy is just the overnight discount rate. So that is the short-term interest rate. The yield curve is the profile of interest at every time period. So 1 day, 3 day, week, month, 3 months, quarter, and year. So that's the yield curve. So basically the yield curve always slopes upward, because in the short run you have just your overnight bill. There's no inflation risk, and there's no risk about changes in the interest rate. So if you want to give a loan to somebody and you say that 1 year from now I will have it back, then you have to build in the possibility that inflation will take place, so you want more to compensate for that risk. And also it might be that the interest rate will go further up, so I will lose the chance to invest, or it might go further down. So there's interest rate risk involved, and that will also build in a premium. So basically people will want more. This is the normal situation. Sometimes things can be reversed. For example, if you have a situation where the interest rate is temporarily very high and you expect that the interest rate will be going down in the future, then the yield curve might turn negative sloping at long intervals. So basically, assuming a flat upward sloping yield curve, if I cut the discount rate from 10% to 9%, the whole yield curve will just shift down. So long run interest rates will also come down. Now it is possible that people look at the future of the economy and do long run trading on that basis. So the cut in the interest rate will not have that much impact on the long run interest rate. But it might also have some impact. Alright, so the first impact of the discount rate is on the yield curve. The second impact is, what does the yield curve do? Well, the yield curve, overnight borrowing doesn't really directly impact the economy. But if somebody is doing some business, he wants to take a long-term loan and to invest in his business, so he will borrow, and if the long-run interest is low, then this is good for investment. So if I want to build a house and it will take me an year, if I want to build the firm headquarters and it will take 1 year, so I will borrow money in order to start building, and I will borrow money at the 1 year interest rate. I can also borrow money at the 3 year interest rate. If the 3 year interest rate is low, then I am more likely to build my firm. If it's high, then so now there are what happens is that suppose I cut the interest rate and the long run discount rate goes down, then basically you see it will not happen very often that people will say, oh, now the long run interest rate has come down, so let us build a new head office. Rather, this planning takes a long time. People have been thinking about it for years, and the loan has already been contracted 6 months ago, so it's a very marginal effect. It's not a very strong effect, but it can also happen. So the short run small change will not have too much impact on long run investments. Now when it comes to consumer spending, then the financing of consumer durables, houses, that depends on interest rate, but it also depends on job security, which has to do with the economic environment. Another effect of cutting the interest rate is that your currency becomes less attractive to foreigners if the funds are flowing in from outside and being placed in your stock market or in your banks. This will be reduced. Outward flow of currency becomes more encouraged. If people want to invest in Dubai and local rates are low, then they will be more interested in sending money abroad. And the effect of these two is that the exchange rate will be a cut in interest rates will cause which kind of pressure on the Pak rupee dollar rate? Will rupee depreciate or will it appreciate? it will depreciate, yes, because the rupee has become less valuable because you get less interest on it. So it will depreciate. So that's another impact of the cutting the exchange rate. If we have high interest rates, then what happens is that interest sensitive domestic spending, both in consumption side, like today people are talking that how are we going to build 1 million houses if the financing for houses is at 15%, and if when the federal bank discount rate is at 10%, then the private commercial lending is usually around 15%. So at that very high rate of interest, people will not want to borrow in order to build houses. So how are we going to build houses? So basically domestic consumer spending as well as domestic investment for the future will be killed off. And so if we use inflation to control, use interest rate to control inflation, we might control inflation, but we will also kill the economy. So basically following the global financial crisis, as we have seen, the EAPC tells us not to use fiscal policy, so a lot of monetary policy was tried, but it did not succeed in doing what it was supposed to do. After the global financial crisis, the economy entered into what is called the Great Recession, where the unemployment increased substantially, and growth rate became very low, which is called stagnation. So now the job of the central banks was to bring down the unemployment and pick up the growth rate, and so they tried many types of monetary policy. None of this worked. So some unconventional types of monetary policy, which had never been tried before, were tried, and these also did not work. So in 2009 in the USA, they said that let's go for fiscal stimulus, and but there was a law that if there is an adverse effect, this will be abandoned, and 1 year later they abandoned it. It is not clear. Well, this is in the USA. What was the cause of this? So now, if we are going to use only monetary policy to control the economy, and monetary policy is only the discount rate, then once the discount rate reaches zero, then you are out of luck. There is no policy anymore. So the result of this was what is called quantitative easing. Quantitative easing consisted of the central bank trying to push a lot of reserves into the banking system. So we have to keep, basically the financiers, again the bank system was not putting money into the hands of the people. That's what the difference between fiscal policy and monetary policy is. Fiscal policy actually spends directly on the projects, so it pays, it purchases goods to build dams with, it finances projects and pays salaries of people. Monetary policy also creates high-powered money, but it takes high-powered money and buys financial instruments. So basically, the reserves come into the hands of the financial sector. And hopefully, the idea is that once the financial sector becomes rich, it will share the wealth with the rest of the economy. But this did not happen. So the quantitative easing put a lot of money into the hands of the financial sector, but the financial sector did not lend it forward, thereby creating investment and jobs and other good things. So what is exactly quantitative easing? Basically, in general, central bank is concentrating on the overnight rate, but now the goal of the quantitative easing is to bring down the long run rate, because it is thought that the genuine investments will be affected by the long run rates. So how can we bring down the long run rates? Well, we can have long run T-bills which are cheaply priced so that the long run interest rate becomes low, and we can buy up instruments which are long run in the private market at low prices so that the yield becomes low. So basically this is called flattening the yield curve, because the long run rate is close to the short run rate. So the inflation risk, etc. Increase the price and reduce the yield. That's right. You take these long run instruments which are in the private market and you buy them at a high price, thereby increasing their price and reducing their yield. So that's so basically the goal is that once the yield curve is flat, then long run investment becomes very easy, because your inflation risk and your interest rate risk, these are all removed. You have a flat planning horizon. So the Bank of England stated that this is how Q is going to work. This is how it's going to stimulate the economy. One is that once we start purchasing financial assets, then the financial assets and basically one of the things that happened was that these mortgage-backed securities became worthless. So they basically there was a lot of uncertainty about any kind of paper, because once the bank is issuing paper of any kind, it is backed by what the bank has, and if what the bank has is insecure, then the value of that paper is uncertain. So when the central bank says that, okay, we'll buy up all of your worthless paper, then the value of the bank is restored and you get public confidence. When the long run interest goes down, then the present discounted value of your household income stream becomes higher, and so that adds to your wealth. So hopefully you will spend something from there, so that will stimulate consumption. And also when you purchase worthless financial assets from banks, the program in the US was because TARP, Trouble Assets Relief Program. Basically the government bought worthless paper from the banks. So this will give them more liquidity, and that might promote lending. So these are the three channels by which quantitative easing is supposed to work. But it didn't. Actually, the banks did not, although banks acquired a lot of reserves, they did not start lending to the private sector. So the money supply in the form of credit did not actually change very much. So in an effort to force banks to lend, the central banks tried the negative interest rate policy. Both in the Europe Central Bank and Japan, they created negative interest rates on excess reserves of banks. If the banks had legal reserves, that's fine, but if you are holding more reserves, which they were, then you will be charged 0.1%. So that's a negative interest rate. It's kind of like a tax. The Bank of Japan bought 80 trillion yen's worth of long-term paper from the banks, thereby increasing the reserves of the private banks to 80 trillion. And the goal, as it announced, was that to exert further downward pressure on interest rate across the entire yield curve. So the objective of this strategy was to achieve a price stability target of 2%, meaning inflation targeting. But actually the goal was also to stimulate the economy. But despite all of this effort, the lending of the Japanese bank sector to the outsiders, which would have been useful, did not increase.
So the ECB means
ECB? European Central Bank. They also had a negative interest rate policy, and it was also not very effective. So the conclusion is that neoclassical policies based on the Phillips curve are failing. Fiscal policy has been abandoned. Monetary policy has been confined to the interest rate. The conventional policy has failed because we have fallen into what was called the liquidity trap earlier. No matter how much money the banks have, they don't lend it outside because the interest rate is so low. Unconventional policies which were tried to overcome this problem, like the quantitative easing, zero interest rate, negative interest rate, these also failed. The basic problem is the one that Keynes diagnosed in the first place, that there is slack in aggregate demand. If there is no aggregate demand, then there is no demand for money. So basically in Australia, in European Union, Greece, Spain, Ireland, Portugal, inflation has been completely under control. Interest rates have been low, but unemployment has been very high. So monetary policy cannot be used to create full employment, at least not the way it has been done. So one of the reasons that monetary policy was used is because it's very easy to implement, unlike fiscal policy, which requires designing projects, and it's not subject to political interference. The Monetary Policy Committee meets and sets the interest rate. Nobody needs to bother with this. It's understood by financial market traders very easily. They know exactly what's going on. And inflation targeting provides anchors for price expectations, which makes business planning easier. So these are the reasons why people say that we should use monetary policy. But the disadvantages is that this is too blunt. Just the interest rate doesn't work in a timely manner. Whether it is a stimulus or a contraction, just reducing overnight interest rate is not going to have the desired effects. Often it leads to the wrong policy. For example, in the USA, when there was cost plus inflation by use of external oil price shock, then the central bank raised interest rates to try to control inflation, and as a result it caused unemployment. So we had stagflation. Both inflation was not controlled because it was being caused by cost factors which were outside the control of the central bank, and the policy response led to unemployment. So this was the wrong theories, led to substantial damage. Finally, there is a logical point, which is Tinbergen's rule, that the number of goals you have should be equal to the number of instruments. Now we have one instrument, and using this we are trying to control three targets. It cannot be done. You can use one instrument to control one target, then you need another instrument to control the other target, and this is general principle. So if you have only one rule, then you can only do one thing with it. So what are the disadvantages? Basically, sometimes some sectors and some regions are booming, others are not. So a general increase or decrease in discount rate cannot address this problem. You have to go specifically to sectors and to regions, and that's something which monetary policy cannot do, but fiscal policy can. For example, if some region is having depression, the fiscal policy can start a project there. The famous example in the Great Depression in the USA was the Tennessee Valley Authority, which took a very depressed region and started some projects of building dams, etc., and this caused a boom in the economy in that area. And also, when you are looking at the inflation only, then you can impose huge costs to the economy, as has been happening in terms of high unemployment, and the social cost of this is not taken into account by conventional economics. So you can look at the growth rate falling, but you can't see the social impact of unemployment. It doesn't. The cost is not seen, and that's why people follow wrong policies. What about this theory of central bank independence? As we've already seen, the freedom of the central bank occurs in the overnight discount rate, but it has to do open market policy in order to compensate for treasury action. So if the treasury runs a deficit, the bank runs a surplus, and thereby eliminates the excess money. If the treasury runs a surplus, the bank runs a deficit in order to eliminate the shortage of reserves. So it doesn't have the freedom in terms of controlling the money supply. That money supply is always in the control of the government. It is unless you are at zero interest rate, in which case the reserves in the banking system are under the control of the central bank, but this still doesn't have the desired impact on the economy. So central bank is free to do a lot of things and not free to do certain other things, and ultimately it has answerable to the public for its policy objectives, which are, so it's not really very free. So why did this theory of independence come in? Well, basically the first paragraph is the statement which is given by the Bank of England Open Market Committee, and it says that the transparency and predictability are best met by full funding of its financing requirement. Means that the government should have taxes and should have bond sales to raise money to avoid the perception that financial transactions of the public sector could affect monetary conditions, consistent with the institutional separation between monetary policy and debt management. So the government can run deficits by taking debt. That's not discouraged, but so that means that the monetary policy is the business of the central bank, and the government is purely in fiscal area. So it can do taxation and it can do spending. These are the two main things that it can do, and these two, if they are not in balance, then it can borrow, but it doesn't do monetary policy. Now what we are saying is that actually fiscal policy is monetary policy, in the sense that when you do fiscal policy you create money. In fact, the government is in the business of creating money. That's all that it does. So what the statement here is saying is not in clear language. In opaque language, what the Bank of England is saying is the government should not use money creation to fund its financing, and this position is widely held. However, this is not the practice. Even there are two sources supposedly, not according to MMT, for revenue. One is the taxes and one is the bond sales. In fact, they are never balanced, and the government can borrow from central bank without interest. It's just a null transaction, which is equivalent to money creation. But people do this in order to get around this idea that fiscal deficits cannot be financed by money creation. So this rule that you cannot use money creation to fund deficits means that instead of printing money and paying, the government borrows from the central bank and pays. But this borrow is a null transaction because the central bank is also the government. But if you maintain independence, then you can think of this as a separate transaction. So post GFC, the issue arose with great urgency that private sector is in great deficit. What should we do? Should we use money creation? So this was done in the USA. The government printed $1 trillion of high-powered money, and it gave it to the private sector to cover up their deficits. Now, this was not presented as the government using high-powered money to finance its deficit, even though this is more or less what happened. But in fact, the high-powered money was used to cover up the deficits of the private sector. So what is being said and what's really happening is hugely different. On the one hand, we are saying that the government should not run huge deficits, but the private sector can run a $1 trillion deficit. And if the private sector runs a $1 trillion deficit, the government prints the money to pay for the $1 trillion deficit, and nothing happens. The government should not print $1 trillion to fund any food for the poor, hospitals, sick. That's going to be very harmful and cause inflation. But if the private sector runs a gambling scam and loses $1 trillion, the government should just print $1 trillion and give it to the private sector to bail it out. So this is the basis of monetary policy today. Similar things happened in the European Union. Again, in the European Union, money creation to fund government deficits was disguised because it was against the rules. So, regarding this thing that happened, that the government, both in the European Union and in the USA, the government printed money and just gave it to the private sector to fund their deficit. And then in the European Union, this was also given to the government because the government did not have independent power of money creation, so they also borrowed to cover their own deficits. And the European Union Central Bank is not allowed to purchase debt of any government. But what happened was that they picked up this debt on the secondary market. The government would sell its debt to private sector banks, and then the European Central Bank would buy that. So basically, because of the availability of the secondary buyer, it became possible for the government to sell. So indirectly, the European Central Bank also picked up, basically paid for the deficits of the governments as it has to. So one point of view, which is the correct one, is the government is financing deficits by printing money, but the standard view is that the government is providing reserves to the banks in the hope that they will start lending. This is sometimes called pushing on a string, because in the Keynesian times they said that you can lead a horse to water, but you cannot make him drink. So you provide money to the bank and you hope that they will lend it forward. What they do is up to them. You don't have any force in the sense that you can force that money through the bank into the private sector. So the hope was that by printing trillions of dollars, both in the European Union and in the US and UK, this money that is being provided to the finance sector will jumpstart the stalled economy, but it didn't happen. So in the European Monetary Union, the Maastricht Treaty said that all governments, European Central Bank was prohibited from buying government debt. The government is supposed to keep its deficit at 3%, and overall debt to GDP ratio must be below 60%. This was to ensure that the fiscal policy was basically put out of the picture. The government must basically spend what it earns and cannot run up its debt. So, but this could not be done. Basically, the needs of the economy are such that the government has to run a deficit to accommodate. I'll explain exactly why later. And what happened was that the government debt increased beyond the limits, and they sold it to the private market because the ECB picked up this huge amounts. In fact, they have more. They picked up huge amounts of government debt in the secondary market to give the government. When they were not doing this, when the European Central Bank was trying to hold the line, then the euro started to depreciate very badly, and so finally one day Mario Draghi, who was the governor of the central bank, he said that okay, this is the line, and we are going to do whatever it takes to support the euro at this point. Once he said that, then the monetary policy, then the rate of euro stabilized and stopped going down, and basically he backed up his words by basically making sure that the instruments that were not being purchased, he started purchasing them, and that made sure that all the loans were stabilized, the interest rate stabilized, and the value of the currency stabilized. Otherwise, the euro debt was not backed, and so the value of the interest rate was going down, and the value of euro was going down, and there was no support from the central bank. So European Union was going into an economic crisis. So the governments require from the central bank price stability, low inflation, exchange rate stability, full employment, prosperity, regional growth, and financial. So this is what the overall targets that the governments give via regulations to the central bank. This limits the freedom of the central bank. So people argue that central bank should be independent. Why do they argue this? Because they say that it frees the central bank from political pressure. Central bank has to make unpopular decisions like raising the interest rate, which harms the public interest, but helps the financial lobby. So for long-term gain, this is the argument that is used. But actually what happens is that the Monetary Policy Committee appointments the government makes to the senior positions. Furthermore, the financial lobby is very much in these positions. Even the senior members of the state bank all over the world, after they retire, they go into the private sector. So they have financial interests. And so quite often, you can see it quite clearly, they protect the interests of the financial lobby against the interests of the public. So quite often decisions are taken which are harmful to the public, but good for the financial lobby, like the $1 trillion bailout of the banks that was done in the USA, and similar actions were taken in Europe. So when the European Union bailed out Greece, actually it was not the bailout of the Greece economy, it was the bailout of the Greece financial sector. The banks in Greece were in trouble and they were given reserves by the central bank. So the banks became stable, but the economy continues to suffer. So this central bank independence is not necessarily a good idea, because actually it's never independent. It's just the question of who is controlling it, whether it's the government, whether it's the financial lobby, or whether it's the public. All three have different types of interests. Finally, there's this issue of horizontal and vertical. As according to the text, the government provides money to the private sector. This is called a vertical transaction. When you private sector transacts with itself, and banks give credit to the firms, this is called a horizontal transaction. So here's a picture of the macroeconomy in terms of horizontal and vertical transactions. So the government is at the top, and in this picture, Treasury and central bank are taken together as being part of the government, so not independent. The private sector can sell real goods and services to the government, and so it receives money from that. Similarly, government spending can be done on sale of purchase of instruments, and foreign exchange and gold can be purchased. So this pumps money into the private sector. So in the middle, the non-government sector, it receives money from the government sector, and then it can keep this in terms of currency, stock, and reserves. This is on the right-hand side. And it can also create money. These are the horizontal transactions. It can create money via bank credit, via commercial paper, via private bonds, via private equity. So firms sell stocks. This is a horizontal transaction by which the firms get money from other private sector. This is called private equity, private bonds. The firms can also sell bonds, commercial paper, and bank credit. These are all horizontal transactions where money trades hands between the private sector to private sector. So taxes are drain on this money, and you can say that taxes are surplus and they go into the garbage can. So this is the picture. So basically, any surplus, you see, if you think of this picture, then you see that suppose that we remove the government sector from the picture, or suppose that we say that the amount of the amount of money that is pumped in by the government sector is exactly the same as the amount which is taken out by taxes, which is balance versus. So now all the money in the private sector is inside money which belongs to the private sector. In that case, the net profits, the net profits plus the net savings cannot increase. So, first of all, take households out of the picture and think of only the firms. All the firms are trying to make the profits, but there's only a fixed amount of money. So when they spend on the net money that they have at the end of the period will be the same as the net money that they have at the beginning of the period. So net profits will be zero. Put in the households back. The households are trying to increase their savings and the firms are trying to make profits. But net gain of profits of households plus net gain of firms will always be zero. So the firms can make profits only if the private sector, the private households dissave. They use up their money and give it to the firms. So the only way for the firms to make profits and for the households to save is if the government deficit spends. So deficits are crucial to running an economy, quite contrary to what most people believe. And taxes, of course. So basically the general picture of how monetary policy is that the government should provide money generously, run deficits, and then use taxes to mop up the extra money from the relevant sectors so that the money flows. Basically, this is the problem with monetary policy or even fiscal policy, that you need to target it to the right sector, otherwise you have problems. So this is the picture of the vertical and horizontal macro relations. If you look at money supply by itself, when Treasury spends, that is high-powered money and that goes to the banks. The central bank can supply high-powered money to banks by purchasing their T-bills or by giving loans with T-bills as collateral. The banks use leveraging to create M1 and M2 in form of loans. They use the reserves that they have to create credit. This is the standard textbook mechanism. The banks use high-powered money to purchase bonds from the central bank, so that is a leakage. The banks use high-powered money to make tax payments, and that's also a drain. So this is the picture of how the money flows in the economy. A bank deposit can be thought of as a long position in fiat money. So if I deposit some money in the bank, that means, a long position means that later on I'm trying to get money, and I will get money from the bank if the bank has money to give me. So this is a long position, because remember that the money just goes into the reserves and I get a chit, which is a IOU from the bank. So maybe the bank will be able to redeem this later, maybe not. A borrower who takes money from a bank now, he has a short position. He now has the cash in his hand. So this is a short position. So there are two types of people, the creditors and the debtors. The creditors have a long position in money and the debtors have a short position in money. So now those who are debtors, they are hoping that money will flow into the economy so that we will have it, so that we can pay it back. Currently we have a short position. We don't have the money that we need. As long as the government spends money, the money will come into existence and we will be able to pay back our loans. But if the government does not spend, this is what is called a short squeeze. There's not enough money to pay back the loans. This can be relieved if some people create credit in the private sector, so via horizontal transaction. But in a recession or a depression, this is unlikely to happen, that people will not lend money to others because economy is not doing well. So suppose that there is a long run short squeeze. The government does not supply enough money to the private sector. What will happen is that in order to pay off my loans, I will sell assets, and when I sell assets, then the prices of assets will decline. This is what happened in the global financial crisis. As the people started selling houses to get money to pay their loans, the housing prices declined, and this is something like the paradox of thrift. As people try to save money to pay off loans, their ability to pay is adversely affected, because as people try to save, the net amount of money available for aggregate demand reduces. When the aggregate demand reduces, then the production reduces and the jobs reduce. So finally, a couple of articles that I would like to summarize. I have these articles so I can show them to you. Basically, what has happened in the world after the global financial crisis is that both long run and short run interest rates have declined massively. There was the hope that this would be enough to stimulate the economy. After all, you can borrow money at zero interest. So there is basically this belief that the private sector can do anything it wants. You just need to provide them with money. So this belief has been basically destroyed, although people are not really openly admitting this, and that's causing a huge amount of problems. So now basically money at zero interest rate is available to anybody who comes in with a promising projects, but there are no projects. Why? Because the economy is not a private entity. This basic fundamental fallacy, which is at the heart of the DSGE model and at the heart of all economic models, at the heart of the economic theory prior to Keynes, was that microeconomics is macroeconomics. You just look at what one person can do and you add everything up and you get to what the economy can do. And in DSGE you have only one agent, so this is automatically true. So basically, if you say that, okay, if we provide one person with money, then all opportunities that exist for profit making in the economy will be exploited, because people will see, okay, the only thing that's holding me back from running a profitable operation is lack of money. So now if I can get money, then I can do so if there is investment to be made that's profitable, then someone will be making it. But this did not happen. Why? There are economy is much more complex. There is an aggregation problem. Even if one person is making investment, what we need in order to be able to lend is have general confidence, which means that there should be lots of people who are making investment. Once lots of people are making investment, economy picks up, then this will have a self-regenerating effect. So there is this paper by Liu, Mia and Sufi, which says that long run interest leads to low productivity. I mean, this is a puzzle for economists, that how come, and we thought that if you have low interests, then you should have a booming economy. This didn't happen. So why? So they have this model in which what happens is that the low interest rate leads to they put in two sectors, and they say that, okay, there is a monopoly sector and then there's other sector. So the leading firms invest, and then they invest so much that they acquire a lead over the other firms, and then the competition is destroyed, and the firm acquires a monopoly, and then it stops producing and starts exploiting workers. So this is one way, basically, to explain why low interest has not worked. Summers, similarly, in his article, which let me have a look at, says that long run interest has declined. There has been recovery, but he says the recovery is not the way we think. Basically, recovery means that your actual output is close to your potential output. This is how they measure. So he says that what has happened is that the potential output of the economy has been wiped out. The actual performance has not changed, but what could have happened is no longer happening because people are not investing. So because of the failure of people to invest in the economy according to what should have happened, the potential total output has declined, and so we are saying that we are out of recession because our actual output. So actually things are very bad. Monetary policy has become ineffective, and then basically Summers says that I took the standard FRB models and I said, what would happen if we run fiscal policy? And he said that this leads to great results. Initially the government debt increases, but later on, because the economy picks up, taxes picks up, and so their debt declines. So basically, you come back to exactly what Keynes was saying in 1940s, that fiscal policy is necessary. Keynes said that exactly. He said that monetary policy will not be effective, and fiscal policy is what you need to do, and what you need to do is pump priming. And these lessons have been forgotten and are still not being said as clearly and loudly as they need to be. And today Pakistan is in the same situation. Actually, it seems that the current government does understand this, because people are screaming in the newspapers about how the government is printing a lot of money, and that's exactly what needs to be done to stimulate the economy. So I think that today you understand a lot more about the economy, Haji, than most